welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
They're a very good predictor of demand. They obviously see their roadmap and what their customers are looking to do, not just buy GPUs, but to really run that software and what future models will look like. So I think, regardless of whatever the estimates are, I mean, I've seen everything from, flat to strong beats and raises, right? The bottom line is the demand for GPUs remains incredibly strong.
It's easy to assume that this is the delayed reaction to the Bybit hack, but I don't think so. The Bybit hack was awful, but it was handled really well. And what's more, by Monday morning, the hole had been filled. Over the weekend, the industry showed that it is maturing, that it is transparent, and that it can come together in times of crisis.
I think the bigger idea is, let's just set a low bar, something that we're comfortable with, given all the uncertainty in the environment, all the policy rifts, as we call them, our acronym, for rates, inflation, FX, and tariffs. It makes sense to set a low bar. But clearly the business seems to have bottomed, given what we saw in the fourth quarter in a number of metrics the company talked about on the call. Big ticket, spending, et cetera.
We got 1 hour to go until the market close. Taking a look at the major averages and seeing a continuation of the selling in some areas, but not everywhere. Not in the Dow, for example, which is up 197 points, or about 0.5%. The S&P 500, though, down 0.25%, and the Nasdaq also down 1%. So it has really taken the bulk of the selling here. This 4-day sell-off that, for the averages that are down, is the worst since about September. One of the triggers today, consumer confidence that we got.
Yeah, so what's interesting, Joe, is we had inflation worries. We still have inflation worries, at least in some corners. But now you do see these kind of growth worries bubbling up.
Yes.
Consumer confidence was interesting. It hits, it disappoints. It mirrors the Michigan survey. And I thought it was interesting how economists were quick to point out to their clients, they made a beeline to that expectations index because that is the most relevant to spending growth. That did weaken, they point out, to an 8-month low. You're against this backdrop now where for both consumers and companies, you are just wondering a ton of uncertainties and unknowns about what really the impact of these potential tariffs is going to be.
Yeah, and those growth concerns now are pushing down yields.
Look at 4.3.
4.3, that is the lowest. I'm going back to a 1-year chart here. So it's the lowest certainly that we've seen this year, right? Even going back into December. So that's reflecting some of those growth worries that you're talking about here. Also wanted to point out the sell-off that we're seeing in Bitcoin. That's the one. That's the 1 year. But if you look at today, yes, down below 90,000. And some will argue that Bitcoin's not really a correlated asset, but it does seem to be a risk-off asset. Sometimes, right, when people are worried about
these things. We had the euphoria, the party started at the election, but some of that air seems to get sucked out of there right now.
Yeah, and the other thing that we have to talk about is what's happening with large cap tech, because it is really notable what's going on. Just today, right, you've got 6 of the 7 Magnificent 7 that are trading lower. Tesla in particular, after saying European sales for Tesla down 45%. And so that stock is also trading at its lowest here. Let's take a look at a year chart here. Trading at its lowest since it looks like November.
And of course, Nvidia on deck. Really, I mean, you can say this print really seems to be coming at just a critical time for the market. Obviously, the focus there is going to be, it'll be so interesting. It won't be just, you'll have the top and the bottom and the guide, but then there's going to be so much attention, of course, on the call. Yes. What does Jensen Huang have to say just about how he sees his business playing out over the near and early?
Most definitely. And as we've talked about, it hit a record high on January 6th and has not been able to regain that. One other thing that I want to point out when we're talking about the Magnificent 7, again, collectively, there is an ETF that tracks them. It's called MAGS. It's this round hill ETF. And what we have seen now is that from the highs where we were late last year, we're now looking at about an 11% sell-off in the Mag 7. You know what that means? A correction in those stocks. Now, is this correction going to be followed by a bounce back? That remains to be seen, but we are going to talk to a lot of people about what we're going to see next.
To ask.
We do.
We're about an hour away now from the closing bell on Wall Street. Our next guest releasing a new note. changing his stance on equities and cash. For more, we're bringing in now Keith Lerner. He is Co-Chief Investment Officer and Chief Market Strategist at Truist. Keith, it is always great to see you. So let's talk about this new note, Keith, because you tell your clients you downgrade equities to neutral, Keith. So you're officially lukewarm. Explain why, Keith. What are the reasons?
Yeah, well, great to be with you all. Well, as you all know, we've been big bulls over the last year. And when we look at the weight of the evidence in our work, it suggests a more mixed backdrop, and we're making that adjustment to reflect that. And as I talk about the weight of the evidence, there's a couple of things that we're looking at, and you all have discussed a bit of this. One thing is the economy. We still think the economy it will be somewhat resilient, but we're certainly seeing some softness. You can look at the economic surprise index, which is now at the lowest level since September. You mentioned consumer confidence, weak service numbers last week. So again, I think we're going through a little bit of a soft patch, which is kind of the buzzword, I guess, this week. So that's number one. The next thing that we're looking at is forward earning estimates for the S&P 500. A pillar of this bull market, as we've discussed in the past, has been the earnings have been really resilient. Well, what we've noticed over the last month now, forward earning estimates for the S&P 500 have started to flatline. Again, that's not catastrophic, but it is a shift in that trend. And then thirdly, when we look at the technical side of the market, the price trends, what you see is a very split market. Only about 50 to 60% of stocks are actually in uptrends defined by above the 50 or 200-day moving average. You put that all together ahead of some event risk and the Fed being on the sidelines and some fiscal tightening, to us, it's prudent to at least make some shift in a risk exposure.
So Keith, for people, we have strategists like you come on all the time. You talk about being overweight or neutral or underweight stocks. And just for the people who are watching at home, right, who are retail investors, it doesn't mean sell stocks. It's neutral relative to what, right? Does it mean like you should keep a sort of conventional 40% bonds, 60% stocks in your portfolio? Like, what does neutral mean actually in terms of positioning?
No, I love your question. It's the right one. And because a lot of times, we have strategists, it's like these really big, bold calls. But the reality is, each client has a different benchmark. Some of them are going to be much more aggressive. Some of them are going to be more balanced, like you said. So basically what we're saying is relative to our benchmark, let's just say it's a 50% stocks, 50% bonds. Over the last year, we've had an overweight or more money relative to that benchmark weight in equities. What we're saying is right now, we're above that benchmark. We want to bring back our equity exposure back down towards benchmark. We're not saying this is time to panic. We're not saying this is the time to have 50% cash. But we are saying is that we expect it to be a little bit of a bumpier path. We expect that there's going to be some disruptions along the way this year. That was actually part of our outlook coming into the year. So maybe shaving some of that off and then having a little bit of cash when we see some of these disruptions. And so far, we're only still about 2 or 3% from an all-time high. So we think this kind of corrective choppy period likely has further to go.
Let me ask you, Keith, when you downgraded equities to neutral, you must have been thinking through, okay, well, how could I be wrong? What are the upside risks to my call? So walk us through that.
Yeah, no, as a strategist, I mean, there's no certainties in what we do. That's why we say weight of the evidence. And so what could go well? Well, I think in some ways we're starting to reset those high expectations right now, right? The buzzword, as I mentioned, is soft patch. No one was talking about a soft patch 2 weeks ago. Obviously, we have the big print that you discussed before with Nvidia. That's going to be a big thing in near term. And also, if the administration starts talking back some of the tariffs, that could be a little bit of a relief rally as well. And then also, I mean, maybe in a week or two, some of the soft patch in the economic data actually starts to reaccelerate, or the earning trends start to move up again. So those are all things we're looking at. But again, we're looking at the way of the evidence, and I kind of laid out the picture that at least the things in our work have changed. And again, going back to an important point too is, normally if the economy was going to show a little bit of softness, people would start thinking, hey, the Fed's going to start cutting rates. Maybe they're going to start moving a little bit quicker. But they're basically boxed in our view because of the tariffs. And the only way they'll cut more aggressively than mid-year is if the economy really starts to slow down, which we don't want to see from an equity standpoint.
Keith, it's really interesting that the recent crop of data that you're referring to, the soft patch you're referring to, and the vibe shift that we have seen. I mean, it was last week that we were at new highs, right? So and it feels like things have shifted kind of quickly. And even when we were at new highs, the underlying sentiment did not seem to be great. What has changed? What is going on here? And how do you see that further evolving?
Yeah, in our view, when we were making those new highs, as I mentioned, below the surface, actually, there was only about a half the stocks participating. So even though the headline index made a new all-time high, beneath the surface, you weren't as strong. And you also saw things like small caps actually somewhat weaker. I think right now investors are having a difficult time digesting the frenetic pace from Washington. Again, not from a political standpoint, but like, what does this mean? And what you're seeing in some of the confidence numbers is there's just more uncertainty. And since you had a string of 2, 3, 4 economic reports that were somewhat weaker, I think that's changed people's views somewhat. Now, also, you have to think about this. It's not like the economy is falling apart, but expectations coming into this year, the average economist was expecting U.S. GDP growth well above 2%. In contrast, coming into last year, the expectation was only for 1% economic growth last year. So that bar for positive surprises was really low. And we winded up last year growing closer to 2.5%. So this year, I think the main difference is that bar for positive surprises was set higher. And we're seeing some modest deterioration relative to those more elevated expectations. And what we're seeing right now is a reset of that. And by the way, the S&P 500 is basically back to where it was the day after the election.
Yeah, indeed it is. Keith, thank you so much. We'll see what continues to happen from here. Appreciate it.
Yeah, thank you.
We're just getting started here on Market Domination. Coming up, we're just under 24 hours away from Nvidia's latest earnings results. We'll speak to an expert on the other side about what to expect from the chip giant. Plus, at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more Market Domination still to come.
This year is going to be great. The fourth quarter will absolutely be a huge record, and the rest of this year is pretty secure in terms of what their largest customers are going to spend.
DeepSeek is driving a surge in demand for these NVIDIA GPUs, these H20s that are China compliant by Chinese hyperscalers.
The fact of the matter is it's 58 times on a trailing 12 basis, which is how people have always looked at earnings multiples, not on what they expect it will do, but on what it has done. And if you compare its earnings multiple to some of the other AI companies, let alone other Mag 7 and of course other S&P names, it's at an incredible premium.
One thing's for sure, everyone has an opinion about Nvidia. The chip giant set to report fourth quarter earnings Wednesday after the bell. You might have heard. But it did also make some news today, announcing it's extending its partnership with Cisco in a push aimed at making it easier for corporations to deploy AI systems. A lot of businesses remain in the early stages of adopting AI systems because of the complexity the shift adds to their data centers. So Cisco and Nvidia said Tuesday in a joint statement they're rolling out and broadening the list of products that include each other's technology in an attempt to remove those hurdles. Joining us now to talk about all of this, Daniel Newman, Futurum CEO, who has his own opinions about Nvidia also. Good to see you, Dan.
Thanks for having me.
So we got this Cisco Nvidia announcement. It's interesting, it's coming out the day before earnings, and it's sort of like AI is intimidating. Let us make it easier for you. Is that kind of the vibe of the partnership here? What do you think?
Yeah, so I mean, we talked, I think, last time I was on the show actually about enterprise being this next big opportunity. And the enterprise, there's a ton of complexity. And of course, we hear all about AI and hyperscale. And when we eventually get around to talking about the earnings, we're going to talk a lot about what the hyperscalers are doing and all the CapEx. But in the end, there's this whole other market, which is the enterprises and their investment, their implementation of AI. And of course, there's the InfiniBand and the Ethernet argument. Mm-hmm. And so there's going to be a lot of networks set up for AI that are going to run on Cisco infrastructure. So it just made a lot of sense. Now, the timing, I mean, look, NVIDIA earnings is a national holiday now in its own way. So if I were going to put out news, it's never a bad thing to put it right ahead of an earnings day for NVIDIA.
Let me ask you, so heading into this print, NVIDIA stock has done a whole bunch of nothing so far this year. It's done something. It's down about 5%. Why, if you were to bullet point the reasons why that is, the reasons of concern, what would you say they are?
I think some of it was about people really ran out ahead. They saw what was happening and they started buying up and bidding it up. And it got out in front of its multiple pretty aggressively. Now it's actually trading at what I think is a relatively good value from where it's at and where its potential is, Josh. The thing is the market has digested this. The market has accepted that Nvidia is the early winner. And by the way, $3 trillion market cap is not an underwhelming number for a company that is really still implementing the infrastructure of a technology that most of the revenue is going to come in the future. And I'm not talking about Nvidia's revenue. Their revenue's now. I'm talking about this whole infrastructure conversion to consumption that we keep talking about. They're building, and the question is, are these ghost cities in China? I don't think that's the case. But when does all this investment start to print dollars?
When does all this investment slow down is the other question, right? We got that report from an analyst who said they were doing channel checks at Microsoft and found maybe the infrastructure spending was slowing.
Yeah, the TD Cowen report that came out, I think it was a little misleading. And the funny thing is every time one of these reports that come out that kind of call the early demise of AI, it ends up being an accelerant for more GPUs.
Well, listen, they weren't calling for the demise. They just said maybe it's not as absolutely gargantuan as expected.
But some of the besides Microsoft itself refuting and talking about their 10-year horizon, I think Dylan Patel also came out because he was actually running some of the numbers. And he said that their actual expected investment, if they had gone ahead with every contract, was well above that 85 billion CapEx number. So I think they were pulling back on some. Stargate is, of course, a factor. That's going to sort of change the direction of all this investment. And the sort of tenuous OpenAI-Microsoft relationship. I mean, Microsoft was building out for OpenAI, but OpenAI is going to build its own silicon. OpenAI is going to build potentially its own data centers. It's involved in this Stargate project. I think Satya has been pretty grounded in his communications about how he sees this. He sees, yes, we have to spend for this next 10 years, but he's also kind of come out and said, the revenue's not here. We are getting ahead of ourselves. What do they have, 13 billion revenue on a 85 billion expected CapEx this year?
Yeah.
Dan, let me ask you, when that Nvidia print hits tomorrow, crosses the wire, I'm just curious, what are the data points, the metrics in that report you make a beeline for?
Yeah, I mean, the first thing people are going to be looking at is how that margin integrity is holding up. That margin number has been a big part of what's driven it over $3 trillion. I think another big part of it is going to be any sort of communication about the Blackwell ramp. It's not totally clear how much that shipping has kind of hit capacity, and are there any constraints in their Blackwell ramp? Because I think there's kind of this mixed belief. Some people are like, it's fully shipping, it's fully ramped. Other people are hearing there's some heating issues. What's true? And then, of course, I think everybody here will agree, the guide. Over the last 4 quarters, each quarter, the guide has been a little less aggressive. They've been great. They've been big beats, and they've been raises, but that raise from like quarter to quarter has gotten narrower and narrower, making it even more necessary, Josh, that it's perfect. The guide is perfect. I think the whole market is on stilts. And I think if Nvidia comes up anywhere short, even a mediocre guide, I'm really worried about what's going to happen for growth.
I mean, last time the stock didn't do much. The time before that, it fell about 6%. Both of those times, the S&P didn't do much of anything. So, we'll see. I mean, the other thing we have to look for, it's not going to be in the statement likely, but will be in the conference call, is discussion around DeepSeek, right? And we talked to analyst John Vin of KeyBank yesterday, who's confident that the chips that go into DeepSeek, which I think are the H20s, he expects an uptick in demand for those. But I imagine that's a lower margin product than Blackwell, right?
And there's still a lot of uncertainty around H20. There's still a lot of uncertainty around what Trump is going to do with chip controls. And there's still a lot of question marks around the entire DeepSeek proposition and what happened there. What we did learn for sure from DeepSeek is that the more efficient model will actually lead to more GPU demand. That we are, I think, at less than like 0.1% of the consumption of AI. Now, the infrastructure build, we'll keep talking about that, is happening. But when we learn how to build more efficient models and we learn how to make the infrastructure work more efficiently, I think that scale up is going to happen really quickly. And so DeepSeek, we did learn a lot from, Julie, but I do have a lot of concerns that we still really don't know what happened there, and that the actual infrastructure that we were told versus reality, I'm not certain. And then, of course, all the Trump sort of politics going on between us and China and what's going to happen there. I mean, no wonder that the broader market is super uncomfortable. And this is the most uncomfortable I've seen the market broadly about AI since the sort of first big boom around the ChatGPT launch.
So very on stilts. I like that. We're on stilts. Dan, thank you. Good to see you.
Thanks for having me.
Let's get to some of today's trending tickers, starting with Li Auto. The Chinese car maker stock up double digits today. The company posted pictures of its first all-electric SUV. It's called the Li L8. Li Auto is already one of China's top-selling new car makers, delivering over 500,000 vehicles last year. But this is something in the pipeline that would be different for it. It would be more competitive with the sort of SUVs, EV SUVs on the market already.
Yeah, stock has had kind of a rough run if you pull back the chart. Interesting, Bloomberg analysts who know the name recently said, talked about this company's reset in 24. They were saying should set the stage, in their opinion, for EBIT, earnings before interest and taxes, to return to growth this year on stringent cost controls, they called out, along with better scale and efficiency. So some confident notes from that team.
Yeah.
Our next trending ticker, let's look at this one. That is Sempra. That stock plunging today. That's after the energy infrastructure company reporting weaker than expected earnings for the fourth quarter and reduced its financial guidance for the full year. So this one, stock's falling, not just falling, actually falling to the most on record here. Did cut the earnings forecast for this year. Reports noting California regulators decide to approve less money than the company asked to collect from its utility customers through electric and gas bills, and that seems to be one of the big issues here.
Yeah, I mean, this is something, we've had these like go-go days of utility companies, but utilities are still a regulated industry. They have to have rate increases approved by their regulator, and it didn't get the full rate increase that it wanted here. So this is the California Public Utilities Commission. It said that Sempra's company in Southern California, Southern California Gas, could collect $3.8 billion from its customers in these increased rates through 2027. The company had been hoping for $629 million, more than that. So hence the shortfall here, and the company apparently cutting its guidance for 2026.
And with this move, you have a stock that's now basically flat over the last 12 months.
Exactly. Our next trending ticker is Alcoa, the aluminum producer, warning on Tuesday that President Trump's plan to impose a tariff on aluminum imports could cost about 100,000 U.S. jobs and would itself not be enough to entice Alcoa to boost production in the U.S. Trump earlier this month said he would impose a flat 25% tariff on aluminum imports, quote, without exceptions or exemptions, in a bid to lift U.S. production of the metal used to make automobiles, cans, other products. The Alcoa CEO making these comments in a conference in Florida.
Yeah, we're clearly advocating based on the fact that this is bad for the aluminum industry in the U.S. He said it's bad for American workers. Per the Journal's write-up, the company said it's going to apparently advocate for an exemption on Canadian imports, which I guess would allow something like 2/3 of the metal consumed here to continue to come across the border without a tariff. We'll see if they are convincing.
Well, and one of the points of this is to bring back production to the United States. And the CEO, Bill Opplinger, commenting on this and saying it's very hard to make an investment decision, even on something like a restart, without knowing how long tariffs will last. That uncertainty about the timing. If you knew, I guess, that if tariffs were going to be indefinite, maybe then you would have a little more
timing, carve-outs, exactly. All of that up in play.
Yeah.
Coming up, it is the latest edition of our series, Goodbye or Goodbye. We are going to take a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. Today we're taking a look at rate-sensitive names, and I'm here with Toulouse Capital Management founder and Chief Investment Officer Spencer Hakimian. And let's start with the stock that you're bullish on, and that is JPMorgan. The stock, it's had a little bit of a pullback here lately, but it was recently trading at a record, and the stock is up quite a bit, I think more than 30% over the past year. So let's get to why you still like it and you think it still has more upside. So there's been a lot of talk about the new administration coming in and sort of lightening up regulations on the banking industry. How is that going to benefit JPMorgan?
So, as it relates to big banks, especially commercial banks, Basel III and other regulatory updates that are coming along are going to, at least it's strongly considered by the sector, to help improve profitability. It's going to require less capital up front. And generally speaking, that will help to increase returns on equity, net interest margins, and it'll generally just make a more favorable environment for lending for all big banks.
And their profit margins have already, largely recovered post-financial crisis, right?
Currently, right now, return on equities for a big bank like JPMorgan is basically as high as it's been definitely since after GFC, but even before GFC, we're at like 2005, 2006 prices. Levels. So it's great, and it looks like it may even get a little bit better for banks.
And then also on the sort of macro, big picture policy front, we could be seeing tax cuts coming, or at least an extension of the existing tax cuts. Why is that going to be good for JPMorgan?
Well, at the end of the day, a tax cut will one way or another lead to extra deposits that will flow to all banks. Naturally, JPMorgan being the biggest bank in the United States will get a big amount of those deposits. And these types of deposits tend to be some of the cheapest deposits that banks get in terms of their funding cost. And that's great because they can lend it out, they can go buy US Treasuries with it, they can do a host of activities with it. And generally speaking, deposits up for a bank, profitability up for a bank. So that's just something that we're keeping an eye on as we get towards Easter and those tax cut conversations begin.
Yeah, speaking of taking it in and lending it out, let's talk about net interest margins, right? Because we've got this sort of higher for longer environment. What does that imply for a bank like JPMorgan?
So it's actually ironically been one of the best things that could have happened to banks, especially the big banks, since late 2022, because big banks have a much lower funding cost than the small regional banks do because of a presumed assumption of safety with dealing with a bigger bank. And because that yield curve is expensive, they're lending out that money at, let's say, 200 basis points above the 10-year. They're getting a very nice interest on their money, and at the same time, rates on, let's say, a checking account have hardly moved at all, and the flow to, let's say, accounts that actually pay a yield, although it's been big, it actually hasn't been so big as a proportion of banks' total, deposits, which are their liabilities. So this is just, we think it's a great environment, and I think we're seeing it in higher ROEs, higher net interest income margins. We think we're seeing it all around.
We have been seeing it, certainly for JPMorgan. So what could go wrong? Let's talk about that. If indeed, there have been some slowing growth concerns creeping into the market here. What would that mean for JPMorgan? And I guess how likely do you think that is also?
So at the end of the day, a bank is, it's a leveraged investment on the growth of the economy. They're lending to the economy. So if defaults were to increase, if credit card charge-offs were going to increase, if people were to default on mortgages, people started losing jobs, this is all going to negatively impact JPMorgan. JPMorgan happens to be one of the more conservative banks in terms of their balance sheet. But nonetheless, anytime you get an increase in defaults and banks are a levered business, it's going to hit them disproportionately. We saw it 2008, we saw it Q1 2020, we saw it in 2023, although that technically wasn't an economic issue. So that's always the big risk when you're dealing with a bank if the economy were to go soft. But with JPMorgan, they are one of the most financially conservative large banks. They hold a lot of cash relative to their required capital. And they have such a big exposure to short duration treasuries that they could adjust their book pretty easily if we were to get into a recession. So if we were to get into a recession, they'd be one of the better performing banks in that scenario.
And before we move on to the stock you don't like as much, do you guys hold JPMorgan?
No, we have exposure to the financial sector, but no individual security.
Okay, gotcha. All right, let's get to the stock that you don't think is as good a buy here, and that's D.R. Horton, the home builder. Those shares haven't done very well over the past year. So let's get to what's going on in terms of supply and demand, which is a big deal for the home builders. You say there's oversupply in the Sun Belt at this point.
Without a question.
Yeah.
A lot of the oversupply started in the aftermath of COVID, and as people were leaving the northeastern states towards Florida, towards Texas, towards Georgia, builders responded with excess inventory. And as always, inventory people get a little bit too excited and build too much relative to what actually ends up happening. That population growth decelerated, and now we're in a situation where Florida is oversupplied, Texas is oversupplied, we're seeing parts of the Carolinas start to get somewhat oversupplied. And at the end of the day, this is a builder that has to move inventory. So if it can't move it, it's going to have to lower its price. And that's a lower profit margin than what the Wall Street may be expecting.
Right, margins have been a big focus, I know, for investors. Whereas policy might be positive for the likes of JPMorgan, maybe not so positive for D.R. Horton on a number of different fronts.
Yeah.
Whether we're talking about tariffs or immigration, walk me through that.
Sure. So let's just start with tariffs. Higher steel prices, higher aluminum prices, higher any type of raw material prices. That's all going to feed into higher home prices. At the same time, when you have that oversupply, it's very hard to justify making your customer base absorb that cost. So if you were to model it out, you would expect that more of that cost would have to be absorbed by the home builders rather than by the consumers. Mm-hmm. And that would, again, lead to lower profits. And then again, housing is just a function of population growth to a pretty big extent. Less immigration, whether it's good or bad for, politically, that's just going to mean less people than what was, priced in, let's say, in 2023 or 2024. And if that happens, there's just simply going to be a little bit less demand for housing. And that means, again, builders are we might see supply build up, and it could be a hard situation for builders in 25 and 26.
And then there's rates, which cut both ways, right? We had talked about the JPMorgan upside. Obviously here, high mortgage rates have been a real issue for anyone buying a home, whether it's a new home or an existing one.
Definitely. And specifically in the case of D.R. Horton, they're selling new homes. So the new home market does not have the people that are insulated from rates that are stuck in those 2021 2% rates. These are all people that are going to have to assume a new mortgage. So the demand for a new home is a lot lower than the demand for an existing home. At the same time, D.R. Horton, to try and move inventory, does something called a rate buy down, where they subsidize a portion of your mortgage for a couple of years. And again, that's just expensive. These are all things that are raising the costs for home builders, and at the same time, we don't see the demand out there for new homes right now.
And then finally, I guess what could switch the thesis here on D.R. Horton if we see a longer-term decline in rates?
If we can somehow manage to get the long end of the yield curve, so 10s to 30s, to fall sustainably, and for a long amount of time, not just for a month or 2 months or 3 months, but for half a year, year and a half, while not having the economy fall into some kind of recession. Because the long end usually falls when we're in a recession or a growth scare. If we can somehow manage to get that, we can eventually move these homes. Consumers still have jobs, they still have cash, asset prices are just off all-time highs. So consumers can buy homes if rates get a little bit more affordable and the economy is still there. So things can always change.
Things can always change. Spencer, thank you so much for coming in. Really appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
All right, let's get to a couple more trending tickers now. Shares of Planet Fitness are falling. The company reporting fourth quarter earnings and missing on earnings growth projections. You can see the stock down almost 10% here. So gym operator offers a forecast for annual adjusted earnings per share growth that does miss. They see adjusted EPS growth of 11 to 12%. Estimate was more like 13%. The execs trying to sound a confident tone here. They talk about strong results in 24, 19.7 million members, revenue growth of more than 10%, growing adjusted EBITDA by about 12%, but that is not good enough for investors today.
Yeah, Planet Fitness has had some management shakeups over the past couple of years here. So just putting that in, throwing that in as well. The stock has gained quite a bit.
Run, yeah.
It's up more than 40% over the past 12 months. So kind of let's put that into context as well when we look at this disappointing forecast and about the decline here. The company is planning to open new clubs, about 160 to 170 new locations. So we'll see how that feeds into the forecast as well. Let's talk about Keurig Dr. Pepper. Those shares rally. The company beating fourth quarter earnings estimates on the top and on the bottom line. The shares up just about 2%. And by the way, consumer staples, I noticed, are leading some of the gains that we are seeing today. There was some concern around coffee inflation, right? Coffee costs, as we know, the raw material has been going higher. And so there were some concerns about that they seem to reassure investors about at this point. Organic sales growth beating estimates in the quarter.
Yeah, Jeffries pointed out, saying KDP had a lot to prove in the second half of the year, and they delivered. And they did point out that data point that Q4 organic sales growth did beat. Truist as a whole, though, says the results they call decent. Hopeful that KDP can deliver on its guide, they pointed out, but highlights, to your point, how coffee and FX headwinds still strong.
Yeah, and for the full year, the company says net sales growth will be in the mid-single-digit range, will increase in the mid-single-digit range. That's what we're looking for.
All right, earnings, we know, have taken center stage this week, but with concerns around the monetary and political policies, how should you be positioning your portfolio right now? For more, let's welcome in Bryant Van Krankheit, Allspring Global Investment Senior Portfolio Manager. Brian, it's good to see you. So let's talk about the action we see today in the markets. S&P 500 here, falling for a fourth day. You see investors ducking into the U.S. bond market for cover. What do you make of the action we're seeing, Brian?
Yeah, it's good to see you again. I think the market's a bit worried about a growth scare here, and they're worried about it in the context of the Fed not being there to support them if it does happen, right? The Fed's in a bit of a box. Inflation's ticking higher. Most importantly, inflation expectations are moving higher, which triggers a change in consumer behavior. All that could lead to a growth scare. You pile on uncertainty around tariffs. We've heard management teams talk about the need to raise prices and the ability for that to destroy demand. And what you have are people getting concerned. They're moving into traditional defensives. They're moving into utilities. They're moving into consumer staples, areas that have been ignored for a long time as everyone got excited about the growth around AI and the strong economy. But this too could come to an end soon. So I think the market's being a little bit more careful about where to put capital today.
And it's been interesting, this move, these sort of rapid whipsaws that we've seen in the market as people sort of are trying to reset their expectations. Brian, where are you looking for in the market that is potentially going to be steady through this, or that is going to end up seeing higher returns through this?
Well, whenever you don't have economic tailwinds at your back, you don't have a rapidly growing economy, you don't have the support of a Fed cutting cycle, what we want to turn to are companies that have financial freedom. The freedom to do what they need to do through the cycle to drive and generate their own growth. And so the key to that for us is owning companies that have uniquely built balance sheets that have the ability to be used to drive growth. And so, for example, I want to own a company like Canadian Pacific. They acquired Kansas City Southern, the railroad company, not that long ago. That acquisition still has many years of synergies ahead of them. And we're buying it at a time when the market's focused on things that are more cyclical in nature. They're worried about volume contraction right now with shipping. They're worried about tariffs putting pressure on overall demand. Pricing within rails has been a little bit weak. All those near-term cyclical pressures are putting pressure on the stock. But the balance sheet's in such a great place that they're going to use that capital for buying back their own stock to support their shares. They're going to use it for organic investments to drive synergies out of that acquisition still. And I think we're going to see CP drive unique growth relative to an economy and a market that might be a little more fearful today.
Well, I'm curious specifically about the tariff effect on something like Canadian Pacific, Brian, because like if I'm a manufacturer, I can kind of move stuff around, right, to try and redeploy my supply chain. Canadian Pacific doesn't have, I mean, rails are rails, right? Like you can't like move them around. So how do they navigate that?
Well, that's true. Let's start with that. Rails are rails, and we're not building a lot more of them, right? So these are really unique assets that have incredibly durable cash flow power tied to them. We do have the tailwinds of onshoring and nearshoring. So nonetheless, materials and goods have to get to the US and they have to use some sort of shipping to get there. Yes, we might see some shifts in where it comes from Canada to Mexico or somewhere else, but ultimately they get on the shores of the US and need to move around. One of the most efficient ways to do that is through the rails. So you're right. We're not going to see CP change their asset base around the tariffs. We might see their customers move around a little bit, but ultimately I see that equating to very little pressure on their top line and almost no pressure on their margins. In fact, I think margins expand from here as they get the synergies from that last acquisition they made.
Here's another one you like, Brian, Arch Capital. Now that one has not done a ton over the past 12 months, Brian. It's up about 3-4% here. Why is this one a buy?
Well, a lot of that contraction that you just referenced is in the last 3 quarters, the past 3 months. And Arch Capital, stepping back for a minute, is one of the best run insurance companies we've ever found. They're very good at pivoting to where they see the best returns for the level of risk they're underwriting. They're not dogmatic about being in one line of insurance. And so we see them go from casualty and reinsurance through the GFC into mortgage insurance, where they're writing mid-teens returns on equity for the last several years. And now they're pivoting again back to reinsurance, where we're seeing phenomenal returns on equity that we expect them to deliver over the next several quarters and years. But in the near term, people have been worried about some of the reserves they had on book. which was actually, I think, the market misunderstanding the economics and the financial impact of some acquisitions they made more recently. So what I like about Arch Capital is that we're currently writing business that's going to have very high returns on equity. We're buying the company at a price to book around 1.5 times, which traditionally is a very good price to buy the stock. And we're doing so at a moment when this company has tremendous freedom on their balance sheet to buy back their stock. Something this company has done judiciously over time and usually in a well-timed process. And so we feel very optimistic about their ability to use their capital right now to see us through this current environment.
Brian, good to see you. Thanks a lot for joining us.
Thank you.
Coming up, Home Depot shares higher after the company narrowly beat sales expectations in its fourth quarter. We'll speak to an analyst on the other side to discuss the best ways to be positioned in that home improvement sector. Stick around, much more market domination still to come.
Home Depot announcing Q4 earnings today before the bell, narrowly beating sales expectations and posting positive same sales growth for the first time since 2022 after 8 straight quarters of declines. Our next guest believes Home Depot's earnings are a sign demand is finally beginning to inflect for the home improvement category. And joining us now to help us understand how to play home improvement stocks is David Bellinger, Mizuho America's Director and Senior Analyst. David, it is good to see you. So I do want, David, your take on that Home Depot print because an important sales metric did turn positive. The stock is higher today. What did you make of that report, David?
Hey, thanks for having me back on here. So yes, Q4 was a very solid print for Home Depot. You had the first same-store sales growth number that turned positive in the U.S. since 2022. So a few years in the making here. And then you also had traffic inflect positive. So all good signs, even categories like paint, appliances, outdoor, indoor, garden, big ticket categories, all starting to move in the right direction here. The company's guidance for next year is a little weak, to be honest with you, is a same-store sales growth of 1%. Investors are buying this up, though. They think that's a very beatable number. It sets a nice floor here. You could potentially have a beat and raise story for Home Depot as the year progresses. And that their guidance, too, they don't assume any changes in the macro. Still a pretty weak housing market. Housing activity essentially frozen by higher rates here, but you do have this good replacement maintenance like demand that's starting to inflect better. We think that's a good sign for the overall category.
So I guess the question is, David, what is making that inflect better? And where are you getting your confidence from that it is an inflection and not just sort of a one-off kind of quarter?
Good question. There are a couple data points within this quarter that make it a little one-time like. So you had some weather impacts. You had the hurricanes a few months ago. That drove about 65 basis points of that, just north of 1% same-store sales figure. So a little bit that's commingled in here, right? You don't have a clear up and to the right, but I think you're seeing this slow progression that Home Depot's on very easy comparisons. Same thing for Lowe's here. But just the amount of maintenance that a home requires is such a huge positive here. And in the U.S., you've got a housing stock, a good amount of it that's older than 40 years. And that's sort of a tipping point. That's sort of a leaky bucket, as these companies refer to it, that there's always something breaking in your house. You got to get a new appliance. Your kids are banging holes in the wall, right? There's always something going on that you've got to fix. So that demand is starting to improve. And that's sort of a sign of all the pull forward that we had and all this stepped up activity is sort of normalizing again. And then that's where you're seeing this shift to get to a positive low single digit comp again. It's more of a normalization than anything, but it is a sequential improvement from what we've seen over the past year plus.
Pushing ahead, David, so Lowe's reports results tomorrow. What are you expecting to hear there?
Yeah, it should be a very similar setup. So probably not as good as what Home Depot just reported. They did see the pro business outperform. That's where they lean in more. It's about half of their business. Lowe's, that's closer to 30%. So probably not that same amount of inflection that we saw here. But Lowe's has already guided for 2025. They've given some preliminary numbers. Their same store sales number in their base case, right in line with Home Depot's, a +1. So we think the guidance is, well couched. Investors are already expecting this. So no surprises from Lowe's tomorrow, and we think we'll have another good quarter, but not as good as what HD printed this morning.
So you've got a buy equivalent rating on Home Depot, you've got a buy equivalent rating on Lowe's, and you've got a buy equivalent rating on Tractor Supply. David, I'm so excited to talk to you about eggs. which is the topic du jour. And apparently it's chick season, I guess, or we're coming into chick season here at Tractor Supply. I did not know this. People buy laying hens at Tractor Supply, I guess, or specifically they buy chicks that grow into laying hens. And I guess people are going to want to have their own egg sources right now. Talk me through this.
Yeah, thanks for bringing this up. It's a great question. And we think under the radar positive for Tractor Supply. So all this eggflation hysteria that's out there, you don't think Tractor Supply is the beneficiary right away. But when you peel it back, we think they're going to have a nice Q1, Q2 here because of this dynamic. They basically do this Chick Days promotion. So you can go in the store, you can buy some baby chicks. They're a couple bucks each, $2, $4, $5. But what it does, it gets you in the store. It gets a lot of new traffic. You do have people who are latching onto this backyard chicken craze and trying to get their own eggs, avoid these retail prices. Talking about $5 for a dozen eggs or more is a lot, right? So if you can get around that, it's a nice positive. But then these customers, they're spending on other items, right? You're buying a potentially $200, $300, $400 chicken coop. You're buying feed. You're buying heating lamps. There's all these other pieces that go along with it. So they saw this dynamic back in Q2 of 20 when you had one of the initial egg price spikes. So we think it's coming again. We were at the store this past weekend in northern New Jersey, went with my daughters, no chickens left, sold out of a few hundred chickens immediately. So we think that's a good sign. And we had a lot of good feedback on our report about eggflation and Tractor Supply. We think it's coming, but we do still think it's sort of this sneaky positive for the business.
Chick Days.
Chick Days, there it is. David, thank you so much for your time, those stock picks. Appreciate it.
Thank you.
And while we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.